And now, ladies and gentlemen, please give it up for Lev Mazur, CEO of Quantfury platform. Lev will assess the role of regulation for trading digital assets.
Hi, everybody. It's great being with you today. My name is Lev Mazur. I hope everybody is safe. I was asked to speak, I believe, maximum 15 minutes about regulations and if they're needed for trading digital assets. And at the beginning, I really had a hard time to do it in 15 minutes because to me, the answer is obvious. I've been trading from 1992, doing it in obviously in traditional financial markets, and over the last couple of years, being a CEO of a company called Quantfury, I'm involved in digital assets. And to me, it's a very simple question. The regulations are needed as of today. A lot of people put a bad connotation to regulations. They think about some kind of a government authority comes and regulates, change the rules of the game, but that's not really it. You see, trading, not investing, not holding, trading causes losses. Speculating or trading statistically will cause 90–80% of the people doing this to lose all of what they have or some of what they have, but their P&L will not be positive. Same thing, by the way, with the hedge funds. It's not just correct about retail traders. It is also correct about hedge funds. 90% of the hedge funds close after 3 years of operation. And they don't close because everything is good. They close because they lose money. And we're talking about trading traditional financial assets where they're highly regulated. And they're regulated to protect those participants. You see, there's a market efficiency theory that governs trading, or put it that way, fundamentals of the trading. And it says that all the participants have the same access to the same information available for everybody, being charts, news, earnings, you name it. And none of the participants cannot beat an average over a certain period of time, the performance of that particular asset, let's say S&P 500 or crude oil futures. If it does 15% up this year, you're supposed to not be higher than 15% up this year in total. But availability of all information equally to everybody is key because it protects the participants. And obviously we hear time to time about insider information access, and people get punished for it. And you also have a lot of people trying to get legal advantage, acquiring computing power or trying to get somewhere that they have an access to certain information faster, quicker, beating this market efficiency theory paradigm. Those regulations so far protect to a certain degree in a certain jurisdictions investors more and certain jurisdictions less. But when you trade digital assets, you pretty much don't have any jurisdiction. You come from everywhere. You have a beautiful, transparent blockchain where that digital assets being, so to speak, available. There's a full transparency. You hold it, nobody can take it from you. It's completely decentralized. But once you go to the marketplace, the exchange, where that digital asset being parked, and now you start exchanging that digital assets, trading it, there's a different ballgame. Well, first of all, none of those exchanges, or most of them, don't have a transparency in their wallets. You have a master exchange wallet. And that would be correct to existing exchanges also in traditional financial markets. So if they do have brokerages that have access to them, and those brokerages have accounts, so you don't have your own account in NASDAQ exchange or New York Mercantile Exchange to trade stocks or future contracts. But what those exchanges have is a very tight regulation with regards to the information available to the market participants. In other words, what happened in those exchange, which is clearing the transaction between buyer and seller, delivering the goods from the seller to the buyer and delivering funds from the buyer to the seller as an exchange for the goods and charging the commission. That information available only to the exchange. Nobody knows. No third parties have access to it. So there's nobody knowing about the positions, being bullish or bearish. Nobody knows about the amount of deposits. Nobody knows about anything outside of the exchange itself. And obviously that information would be extremely valuable for traders. If you would know who is long or who is short, what's its currently market sentiment, that would, of course, be gold to many traders, because they could build their strategies and make their decisions based on a total, market sentiment. And it doesn't happen today. However, in the digital assets field, where people trade, the exchanges are not regulated. Therefore, we already know that some of them actually have their own OTC desk, which would be a direct contradiction with the interests of their clients. They also issue products that are not highly regulated, or actually not regulated at all. Give an example, derivatives. Those derivatives have no underlying goods or settlement of those goods. So, as an example, stock being settled between the seller to the buyer, and actually the ownership moves, or the same thing would be where crude oil contract futures traded New York Mercantile Exchange. The underlying crude contract actually has a delivery of actual crude barrels, 1,000 barrels of crude at certain point at time at a certain geographic location. Well, derivatives have none of it, and people just betting on the synthetic price based on certain exchanges, but that betting can also be completely synthetic as well. Means that the price can go down or up, higher or lower than the actual physical price of the asset in certain exchanges that the price is correlated. So what the exchange does is it issues a product which is not much prudent and has a lot of risk. But the most important thing is it has direct contradiction with the client's interest, because now they can actually trade against the client, use that information themselves, and we know some of them have their own OTC desk that actively trade, and that's a problem. For those exchanges to regulate themselves and maybe not be exposed to that interest to make a lot of money other than just charge the commissions and the fees, meaning not trading on the exchanges, which we know actively do. To regulate themselves is their own interest. And the reason is because long term, the clients will lose much more money. And those exchanges, basically the liquidity of those people who trade will stop to exist. They will either lose their interest to trade because it's just not fair for them, or will not be able to trade because they don't have funds to trade. And to regulate themselves is also an option. It doesn't have to be a government that comes in a particular jurisdiction and imposes certain regulations. We, for example, in Quantfury, have imposed on ourselves certain regulations, such as full transparency of the trades happening on the in Quantfury between Quantfury users that trade at exchange prices, as a matter of fact, physical exchange price without any fees and any commissions. So there's a smart contract where everybody can see their trades, can see the prices, it can be compared. Most of those centralized exchanges or centralized brokerages, they could try to regulate themselves and bring some transparency, accountability to their users, and enforce market efficiency theories to be governed in place also where digital assets being traded. Obviously, decentralized exchanges or decentralized marketplaces where various financial assets or products being traded, digital assets being traded, do not require regulations, but they will require market liquidity, constant market liquidity, which I'm concerned about the possibility of retail traders just bring it constantly. So you will need market makers to come to those places, which unfortunately we don't see it as of today, but it could change. So for me, being in this industry for the last 28 years, trading pretty much everything available out there, you know, starting from forex, options, stocks, futures, derivatives, fixed income products, and today crypto. I would say that the regulations for any centralized marketplace that allows users to trade digital assets is a very welcome development, and I think that the industry itself has to welcome it. And if the regulators have a tough time to understand what digital assets are and how to regulate them, there's a lot of tools on the blockchain today to do it yourself. And obviously, personally, I would love to see decentralized places for trading digital assets flourish, and hopefully we'll see that in the near future. Thank you for your time, and I wish all of you to trade with caution and be healthy. I hope to see you soon.